Let me turn to my thoughts on the Fed, and not just because it's topical, but because it's the very most important influence over all asset classes, and everything else is tied for second place. It was just over a year ago that Jay Powell, at the August 2021 Jackson Hole Symposium, gave a rousing speech espousing the secular disinflation theme. And at that point, the futures contracts, if you remember, were predicting a zero Fed funds rate as far as the eye can see. It would have been nearly impossible to have taken what was a vigorous defense of, in quotes, transitory back then into the radical reversal in policy that we've seen since. So consider this part of my diatribe the lament and evolution of a central banker, Jay Powell. From my perspective, the Fed is ashamed, it's embarrassed by missing the inflation bulge, even though the acceleration in inflation lasted, the grand total of 16 months. And since I always look at the big picture, and I am not a trader, I would say that in the annals of economic history, 16 months is pretty transitory. But starting this past March, Powell decided he'd seen enough, and I'm sensing that this has turned personal, like the opposite of what Michael Corleone in Godfather 1 said. It's not business, Sonny, it's personal. And what I mean by that is that Powell simply became tired of all the maligning comments and criticisms from the sidelines from the likes of Larry Summers, and especially all the comparisons this past year to Arthur Burns of the 1970s. So this is what it's all about. Jay Powell is not going to have his legacy compared to Arthur Burns. He's going to have his legacy compared to Paul Volcker. And he draws that comparison constantly. And we don't remember Volcker creating the conditions for back-to-back recessions and a 3-year bear market in equities, and the fact that Don Reagan, the Treasury Secretary at the time in the early 80s, did everything he could to get Ronald Reagan, the president, to fire him. We only think back on Paul Volcker with reverence and love, with having slayed the inflation dragon. At the time, however, if you were a market participant trading stocks on the long side, Volcker was public enemy number one. Let's not forget that. And Volcker had to attack a persistent double-digit inflation over a 12-year period. When you look at the core PC deflator today, it's running just about 4%. That doesn't sound much like the 1970s or early 80s to me, but when you listen to this current version of the Fed, that seems to be their biggest fear. So here's the most recent evolution. The Fed starts to tighten in March. And it was then that Powell told us, in quotes, that he was not assuming near-term supply-side relief. I shuddered at that comment because how can you possibly forecast inflation without a view on the supply curve? The Fed is only focused on demand, and that's a problem because we are in fact seeing big-time relief on the supply side. We see that in vendor delivery delays, which are back to pre-COVID levels, commodity prices, which are in a bear market, freight rates have dropped precipitously, and we've even seen a thaw in the past several months in the participation rate, especially in key demographic groups like the youth, adult males, and working mothers. But this Fed is turning a blind eye to the supply side. And I say to that, big mistake. And then in June, Powell indicated that the Fed was turning data dependent, and that's what helped prompt that 2-month relief bear market rally in equities. As it turned out, after back-to-back GDP contractions and what looked like a very meager third quarter for economic growth, that data dependency is really just the headline inflation rate. So Powell may as well just come out and tell us that what he's targeting are gasoline prices and imputed rents, neither of which the Fed really has a whole lot of influence over. But one thing is for sure, considering how the market-based and survey data on inflation expectations have rolled over, not to mention the turbocharged US dollar, the inverted yield curve, the sagging CRB index, not to mention the collapse this year In the most economically sensitive stocks, the Fed is certainly not including market signals in its so-called data dependency. Then, of course, in stark contrast to that August 2021 Jackson Hole, when Powell was still playing the role as the nation's resident social worker, this most recent one included one word, which was pain. The pain the Fed intends to inflict on the economy. That's a big word, even more so since we're seeing relief on the supply side that Powell seemingly is willing to ignore, ostensibly because the Fed is in a once burnt, twice shy mentality. But to emphasize, the supply side of the economy is thawing out, and it will continue to thaw out. And between the dollar and commodities, our models show headline inflation slicing below 3% in the next 12 months from over 8% today. But by then, it's going to be too late to save the economy, and I would posit that the Fed has already done the overkill as is. This Fed seems intent on correcting one mistake by over-easing with another mistake by over-tightening. It continues to pursue a policy focused on lagging and contemporaneous indicators, which seemingly it has no clue as to what forward-looking barometers are saying about inflation in the future. But again, looking at the shape of the economy, the dollar, commodities, this really can't be about inflation in a traditional sense. It has to be a case of taking the punch bowl away. Caveat emptor.